Hey everyone, welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm going to be talking about a recent CFPB announcement regarding land contracts. And I kind of wanted to give you my assessment of it. There were some things in here that were surprising to me and a lot of things that were not. So if you're not familiar with the CFPB, that's the Consumer Financial Protection Bureau. So they're a government agency and they, like many other government agencies, are involved in regulation with mortgages and generally owner occupied mortgages. So stuff that the CFPB talks about doesn't generally pertain to investor loans or loans on vacant lots, chattel loans, things like that. But when you're talking about loans on owner occupied residences, that's where they tend to apply. And so the announcement that they made the other week was related to how their regulations apply to land contracts. So if you're not familiar with land contracts, a land contract is, in my mind, it's basically the same as a mortgage. It's a loan someone's taken out generally on a primary residence. The big difference is a land contract kind of tends to work like an auto loan. So if you've ever taken out an auto loan, let me back up. So when you do a traditional mortgage, right, you get the title to the property and you as the borrower and homeowner are on the title. A land contract works kind of like an auto loan. So if you take out an auto loan, the bank holds the title until you pay off the loan, and then they transfer the title over to you. And, generally land contracts were kind of done a lot in seller finance. And a lot of these were created after the financial crisis. There were a handful of big companies that went out after the financial crisis and bought a ton of REOs from Fannie and Freddie at rock bottom prices. So there are companies like Harbor Portfolio and Window Rock and Vision Property Management, and I'm sure there were a bunch of others, bought these REOs and then put borrowers into them on land contracts. Now, one of the other differences between a land contract and a mortgage is, depending on the state, mileage varies widely when you're talking about these rules state to state. But, by and large, if the borrower defaults and you need to take the property back, it tends to be an easier, faster, cheaper process on a land contract. And so that's why a lot of these lenders would just do land contracts. And what many so another difference has been for mortgages. After the financial crisis, they put all these rules in place, Dodd-Frank and others, where that say if you're creating a mortgage, you need to validate the borrower's ability to repay the loan, right? So that was to eliminate all the craziness pre-financial crisis of lenders in some cases collecting a large down payment and then not caring if the borrower can pay back or not. So like, I'll just foreclose and take the property back. With Dodd-Frank, some other things they said that you as the lender, if you're creating a mortgage, you need to actually verify if it's owner occupied. That's a key difference, right? This doesn't really apply to investor loans, or if somebody's like buying a property and they're going to rent it out, then this stuff doesn't apply. But if somebody's buying the property, they're going to live in it, it's their primary residence. If you're going to originate a loan for them, you need to make sure that they actually have the ability to repay. So they have enough income that they can pay this loan, and their other debts service levels aren't high enough that this whole deal makes sense for them. They're not just going to default right off the bat. And so what the CFPB announcement said was that all these rules, Dodd-Frank rules and other ones that apply to mortgages, these also apply to land contracts, which makes sense, right? Because if you, and I've been doing a lot of deep dives on all of these rules for originating mortgages over the last several months. In fact, in coming episodes, I'm going to be talking a lot about this, because I'll tell you what, it was a lot of work to figure out how these rules worked. A lot of them are very gray. There's multiple agencies. It is super confusing, like crazy confusing, but I feel like I understand it a lot better now. And so I'm going to help clarify a lot of this stuff as in the coming months. But basically what I learned going through that deep dive if you look at how a lot of these rules are created or why they were created, to me, they make a lot of sense, right? I mean, you don't want people putting borrowers in homes when they know good and well that they can't afford to pay them. So at a high level, all these rules make a lot of sense. So it makes sense that the rules, it doesn't make any sense to have two sets of rules, one for mortgages, one for land contracts. And the thing that I found surprising about the announcement was I had always been advised by my attorneys if I was creating a new land contract, which occasionally I've done, if I'm uh, selling an REO, generally I always like to create a mortgage. So you as the lender, you've got a big incentive if you're creating a new loan on seller finance to do it as a mortgage anyways, because they're more valuable in the market. There are a lot of note investors will shy away from land contracts. And one of the reasons is you as the lender are on the deed. So if your borrower starts racking up code violations, and in some cases water bills, people are going to come calling you. And if you ever want to resell that loan on the market because you've got a bigger pool of buyers, because some people won't buy land contracts because they don't want to be on title, uh, those loans are more valuable. So number one, it kind of behooves you as the lender to create the mortgage anyways. In some cases, I've restructured loans or done modifications, and I've ended up just creating new land contracts for the borrower because it's a little more simple. But in the process of doing that, my attorneys always advised me to play by the same set of rules as mortgages anyway. So the announcement was a little bit of a surprise to me in that I thought all of this stuff already applied to land contracts anyways. So it didn't really impact me too much. But let's go through this announcement a little bit, and I'll put a link in the show notes if you want to go through here and read it yourself. One of the things that was interesting was the advisory opinion says it's released in conjunction with a field hearing the CFPB is holding in St. Paul, Minnesota. It says that contract for deed loans have become increasingly prevalent in the Twin Cities Somali Muslim community. The loans are often marketed as a way for community members to abide by the principles of faith that prohibit paying or profiting for interest. This was really weird to me. So I'm by no means an expert on Muslim finance. It's a whole thing because they have some beliefs around paying interest. And so, and not just in mortgages, but in the world, there are these like Muslim friendly loan products that basically allow people to pay interest without saying they're paying interest. I had no idea that people were doing that with land contracts, and I'm not even sure exactly how on earth that would work exactly. But one of the things I've learned too is there are a lot of bad actors out there. That's part of why the CFPB exists. So I guess people are out there preying on Somalis in the Twin Cities, which it doesn't shock me that somebody would do that. And then it says contracts for deed, also called land contracts, installment land contracts, land sale contracts, or bonds for deed. I've also seen them called agreement for deed, and I think some others that aren't even listed here. And it says they're structured such that the seller retains legal title of the home until the borrower completes all the payments. And then during the contract term, the borrower often carries responsibilities of home ownership, including repairs, property taxes, and improvements. That's pretty normal, right? I mean, if you compare this to auto loans, you buy a car and take out an auto loan, the bank holds the title, but yeah, you're doing the maintenance on the car, right? So that all seems fine to me. I'm not sure why they consider that such a big deal, but whatever. And then it says many lenders using contracts for deed generally sell homes at inflated prices with high interest rates and balloon payments. I think that when people do seller finance, and this is one thing you have to keep your eyes peeled for if you're looking at buying a seller finance note, your seller finance property buyer is often comparing it to rent, and they're not as savvy and they're not as interested in the total price. And so a lot of times when people sell properties using seller finance, it's true that they will kind of oversell it, inflate the price, and the borrower doesn't know or care because they're just looking at it compared to rental rates. So if you're buying those notes, the property may have sold for X price, but it may not necessarily be worth that at all. And so people generally do that. I would say that instead of this being a contract for deed phenomenon. It's more of a seller finance phenomenon, right? Because you can do the same thing, whether it's a mortgage or a contract for deed. So I'm not sure why that particular thing matters too much. And then they also go on to say that contract for deeds often come laden with traps like balloon payments. I actually haven't seen a lot of balloon payments in land contracts or loans in general. So one of the other changes they made after the financial crisis is there are limits if you're originating a loan for an owner occupied property on when balloon payments can happen and how big they can be and all of that. Again, that applies whether you're talking about land contracts or mortgages. At least in my experience, I haven't necessarily seen balloon payments more often in a land contract, so I'm not quite sure what they're talking about there. And then also too, for you as the lender, right? Like to me, it doesn't make a lot of sense to write a balloon contract into a payment unless for some reason you're like, unless it's like a bad actor. And I'm sure people out there have done this, right? Where you're going to oversell the property, collect a large down payment, and then put um, one of these they call high risk features like a balloon payment to try to trigger the borrower to default. If somebody's doing that's really nasty, but that's illegal whether you're doing a land contract or a mortgage anyways. And it says, well, many sellers have abused this financing structure to trick buyers and churn homes. These contracts are in fact covered by the Federal Truth in Lending Act. Again, I thought this was the case already. Like I didn't realize there was some difference between land contracts. So I was already following this. And it says this law imposes certain requirements on large sellers, often investment groups, such that they must. And then I'm going to get into these three things that they list. Now, when it says large sellers or investment groups, what I think they're talking about here, it's not totally clear. It gets into the Dodd-Frank ability to repay stuff, right? And when Dodd-Frank came out, I'm trying to remember now the specific language. They said that you have to validate the ability to repay and do all this stuff if you were a quote unquote, I think the language they used was habitual loan originator, like if you're doing a lot of these, but it didn't specify what that was. And so Seller Finance Coalition, other people pushed back on them to get some definition of like, what does habitual mean? And then they came back later and said, well, if you're doing 3 or more a year, that's habitual. You need to play by this other set of rules. And so I think that's what they're referring to. So anyways, and then the things that they're saying you must do for a land contract is number one, assess borrower's ability to repay loans. Duh. I mean, of course you should do that, but it says that determining a borrower's ability to repay, make sure they can afford to repay loans, including contracts for deed. Many people who bought homes through contracts for deed and were kicked out of their homes and missed payments would have been protected against these predatory products that sellers assessed ability to repay. So what this is saying is you need to go through and assess the elements of the ability to repay. You're making sure that the borrower has enough income, enough assets, and they don't have too many additional debts. They have enough residual income that if they buy this property, they'll be able to make ongoing payments, which, I mean, this is one of those many cases where your incentives as the lender and the incentives of the borrower are pretty well aligned, right? You should be originating loans that you want the borrowers to be able to repay. And you would want to do that whether doing a land contract or a mortgage anyhow. And then the second one, this is really interesting, provide informative and accurate disclosures. Sellers must provide the Truth in Lending Act required disclosures. So this is like the LE and the CD that you get. These disclosures include the annual percentage rate and payment schedules. Predatory lenders will sometimes market contracts deed to faith communities and lead buyers to believe the contracts conform to religious bans on interest. However, these loans either do come with high undisclosed interest rates or the interest rates are hidden through other means. Again, this is curious. Like I'm wondering how they do that. If they're maybe for the people who don't believe in interest, are they just like inflating the price and saying this is all principal? I'm not really sure. But generally when you do a mortgage, right, like there's the preliminary disclosure that comes out 7 days before you close. and then the final closing disclosure that comes out 3 or 4 days before you close. And they're saying you need to do these on land contracts as well. And then limit balloon payments. So there are some rules specifying limits on size of balloon payments and timing and things like that. Like you can't create a loan and then say there's this gigantic balloon payment due 12 months later. And this all applies to land contracts as well. So, to me, this was a little bit of a nothing burger, since I thought all of this stuff already applied. And really, whether these laws existed or not, you as a lender, if you're creating a seller finance loan, I mean, these are things you want to be doing anyways, so that you have a valuable and lower risk and paying loan that you're not going to have to go and foreclose on either. Oh, there was one other comment in here that I think I missed that kind of jumped out at me. It says that through land contracts for deed, borrowers are sometimes kicked out of their homes for missed payments. And there was a line in here somewhere saying that they could get kicked out even for missing one payment. I've never heard of that before in my life. Usually states will sometimes have a different process. Like you'll go through a forfeiture process for a land contract versus a foreclosure, and it can be faster. I've never seen a scenario where you could kick a borrower out of a home for missing one payment. So I don't know where they're getting some of this stuff. So anyhow, that's my take and kind of my reaction to the latest CFPB announcement. And let me know what other questions you have or other things you want to know related to seller finance or originating loans. Again, it's an area where the way the regulations are laid out, they are super confusing. There's a lot of gray areas, although when you actually peel the onion back on them, they actually kind of make sense when you get to the end. So if there are other things you want to know, let me know in the comments or drop me an email at dan@fusionnotes.com, and I will see you guys next time. Thanks.